Why are the FIIs selling? How much more will they sell? Where are they deploying this money? Foreign investors are offloading equities continuously. After the market hours, the WhatsApp groups gets flooded with these statements and the FII selling figures. And it makes us wonder whether they have lost confidence in India as an economy, or will the valuations really correct meaningfully even from here at this stage. It is interesting to see that the FPIs have doubled down on debt that is close to 40,000 crore, and it is still counting. And pouring of this 40,000 crore was in March 2025 alone. While the debt inflows do not solely drive the rupee, experts note that they support the rupee substantially. Since January 25, the rupee fluctuated, depreciating to 87.8 per US dollar uh, in January and February, before recovering to 85.69, 85.7 by March 25. While most discussions on foreign flows focus on equity investment, foreign institutional investment flows into Indian debt markets have quietly gained momentum. As of March 25, according to NSDL data, net inflows stood at 39,800 crore compared to 20,250 crore in net equity outflows. Drivers for the segment, according to experts, come on the back of India's inclusion into the JP Morgan Bond Index, anticipation of further rate cuts, as well as India's strong macroeconomic outlook. Most of these debt flows are generally passive. 2 to 3 months back, the case was opposite, since there was a sharp jump in the yields on the US Treasury notes, which caused redemptions in emerging market debt, impacting the passive flows. Now that the tides have turned the other way in India's favor, India is enjoying the high debt inflows. This momentum should pick up in the coming days and months in anticipation of India's inclusion in the FTSE Russell Index, which should probably happen by September 25. The trend of higher FPI debt flows, supported by India's inclusion in global debt indices, has improved the portfolio mix. For a growing country like ours, this is not a bad outcome. This is the statement made by SEBI's whole-time member Anant Narayan at a recent event, Association of Registered Investment Advisors event. Adding to that, he said that the overall FPI flows into the country remain positive, driven by increased debt inflows. According to data, year to date is Jan to date, FPI flows into debt was around 50,900 crores against equity outflows of 1.3 lakh crores as of March. Over the past 5 fiscal years, the total FPI inflows amounted to $54 billion in dollar terms, with 33 billion directed towards debt and 21 billion directed towards equities. Hence, the overall foreign positions in Indian markets are safe and hedged naturally. With the figures of daily FII purchase and sales in equity now can be termed as a mere volatility or good point of discussion. But there is no point to worry about any FPI outflows from equity.